Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Inflation data comes in lower than expected, leading the market to new highs for the year. Famous investor Warren Buffett says, "Be fearful when others are greedy, and be greedy when others are fearful." The inverted yield curve that we're seeing in the markets right now has not been this inverted since 1981. What does that mean for your money? Let's just get right into it. So inflation data report came out on Wednesday. Let's take a quick look real fast and see what it looks like. Expectations were 0.3, came in 0.2%. All right, that's what caused the markets to shoot up to a new all-time high for the year. But is that a good sign? Does that mean the Fed is done raising interest rates? No. The Fed has came out and said, we've had 3 to 4 Fed officials come out and do interviews, reports, do different kind of news events, and they've said, clearly stated, that their fight in inflation is not done, that they're going to raise interest rates again, and they're leaning towards at least 2 more times. If jobs numbers start shooting up, inflation data continues to come down, maybe that leads to only 1 time. But they're leaning towards that 2 more times, and they're going to continue to squeeze the market despite inflation data coming down. So as investors, we need to realize this. The equity markets are making new highs for the year and are staring in the face of the Fed saying, hey, Mr. Fed officials and Mrs. Fed officials, we don't necessarily believe you. Let's flip to what I said earlier of a famous quote by Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. And that means if most investors are feeling this extreme greed, there should be warning bells going off. I want to show you something from CNN Money, the Fear Greed Index. Let's take a quick look at that. Where are we sitting at right now? We're in this extreme greed scenario. Extreme greed scenario, that means the warning bells are going off that, hey, everyone's on one side of the trade right now. Everyone is buying at highs of the market. Flip side, we would have seen the opposite in October of last year. Just so happened to be the bottom of 2022, where we had extreme fear. And as investors, we don't want to be on the side of every other investor. That's that herd mentality. We don't want to be there. So who's buying this rally? There's on Wall Street, we have a definition of 2 types of investors. We call that one smart money, and we call the other one dumb money. It's an unfortunate name, but unfortunately it turns out to be true a high percentage of the time. So who's buying this rally right now? Well, unfortunately, it's dumb money, because let's take a look at what smart money's doing. And just so to clarify, smart money is your institutions, your billionaires, your CEOs, insiders of the corporation, where that's the dumb money, what Wall Street refers to as your retail investors, your neighbors down the street, your aunts and uncles, your cousins, your brothers, your sisters. That's unfortunately dumb money, unless maybe those people that I just named are insiders of a company, and then therefore they would be smart money. So let me show you something. What is smart money doing right now? Well, the billionaires, corporate execs have dumped $9 billion with a B worth of stock this year amid the market's latest rally. And let me tell you folks, a lot of it happened in the last 2 months of this rally, because we've seen a parabolic move in the markets, shooting up, a lot of euphoria. And again, when the markets start going one direction, the train has left the station, I like to say. Don't be on that side. But again, always understand your time frame of your investments. So, I mean, if you're shooting for 5, or let's say 5, let's say like 10, 20 years down the road, you got a really long time horizon, you probably don't care what I'm saying right now. But if you're in this short term, trying to make money, you need some cash, you're looking to make some investments and taking advantage of this market volatility. When I say market volatility, I mean the ups and downs of the market. All right. So long term, understand your time horizon and when you're going to need your cash and what you're investing in. So let's move on to this inverted yield curve that we need to be hyper aware of. Everyone's ignoring it. They're not talking about it anymore. It was a hot topic last year in March when the yield curve first inverted. And what I'm referring to is the 2-year Treasury and the 10-year Treasury. Normally, the yield curve goes like this. You have your short term, yields less than your longer term, right? So if you have a shorter term yield, your bond or a note, you're getting less money. If I have a longer term one, I'm tying up my money for a longer period of time. I expect more in return if I'm going to tie up my money for a long period of time. So what took place last year in March? Well, the yield curve inverted, meaning that short-term rates, the 2-year, is yielding more than the 10-year rate, which through history has indicated signs of sickness in the economy, all right? And this sickness really doesn't start showing extreme warning signs based on history for anywhere from 12 to 24 months. And we're 17 months from when the Fed started raising rates, and 17 months when that yield curve first inverted. So we're in this window, but not quite at the very end of it. And there's also another thing that I want to point out. The money supply that was printed in the system was nearly 80% of the money supply that was printed 2020, 2021. So, it could take a little bit longer than that average 12 to 24 month period because there's so much money in the system. People had so much money to spend, so they can get by as the economy and money supply tightens because they have cash in the bank, other investments, and places they can pull and get capital from. So I have a very important chart that I want to show you. It's from the St. Louis Fed, and this is what the inverted yield curve has meant throughout history. And then we'll get down to how accurate this is. So let's take a quick look. I want to pull this up for you. So this is, from the St. Louis Fed, and the pink lines coming down the middle, those big shaded areas in pink, are recessions. That line that says 0 going across the middle is that inversion line, and then the ups and downs, that blue line, if it goes below the 0 line, that is indicating an inversion. So you'll see the numbers, they're circled 1, 2, 3, 4, all the way until 7. This chart goes back to 1977. So the last 7 times since 1977, the inversion has always taken place before a recession. It has been accurate since 1977 every single time. And you can see what happens after these inversions take place. Folks, things get ugly. Things get ugly, but not initially when the inversion takes place. It's generally when the inversion starts to de-invert. So when I say inversions coming down, gets past that 0 line, and then the de-inversion starts to take place, that means the Fed starts cutting, and that's when we see the real true pain of that tight monetary policy. All right, quick look at the history and how accurate and how reliable is this. I showed you from 1977. But this thing goes back a lot further. But let's give you some data from at least from 1955. An inverted yield curve has accurately foreshadowed all 10 recessions since 1955, according to the data from Federal Reserve Bank of San Francisco. So it's predicted all 10 of them since 1955. There was one false inversion that took place very quickly, end of the 60s, and that was the one false time that we've had since 1955. So as you can see, this inverted yield curve is very, very accurate, and we need to heed its warning and be cautious about our time frame of our investments. So I said, when you're making these investments, be very conscious how long that you want to hold these things for. We have the potential that we're going to see the economic consequences of the tight monetary policy coming very, very soon. So if you're getting in investments thinking that you're everything's going to be great, all clear, bright, sunshiny in the next year or two, as you can see, that there is clear warning signs. Heed the warnings, folks. Obviously, there's a lot more at play. They can start printing more money. There's a lot of things that they can do to kick this pain down the road. And we have an election next year, so there's politics involved in that. So we have to be very aware. Types of markets, you can make a lot of money depending on what market you're in, so keep that in mind as well. But another market that we need to take a look at real fast, because this is an illiquid market, your housing market. And I have a lot of clients asking, hey, what's going on with the housing market? And I always tell them, it really depends on location. It's a little outside of my lane, every single location. So I'm just going to talk on the broad U.S. housing market as a whole. I want you guys to take a quick look of housing prices adjusted for inflation, and you're going to see a theme through this. So you can see here where the housing market, it usually slowly rises through time. Every once in a while has a massive meteoric rise, followed by a lot of pain. Now, look at the big one, 2006 or 5, 6, and then and then you'll see at the very top of 2007 where it's labeled housing bubble. I didn't put that there. That's the St. Louis Fed and this long-term trends chart that put that housing bubble there. And what happened after that housing bubble popped? We have 4 years of decline. Lots of pain in the housing market. Where we are today, prices are above that housing bubble mark there. It's on the decline right now. And is it going to keep going straight down? No, that didn't even happen in the housing bubble. There were some ups and downs for a period of time, but our prices are very extended compared to people's income have not near risen to keep up with the housing price increase, and rates are still very high. They went up even higher the last couple weeks, and they're going to maintain it. They're going to keep these rates high for as long as they possibly can. And you hear all kinds of, oh my gosh, there's low inventory. Well, there's a ton of second and third homes that could bring inventory up. Home builders are building homes at a very rapid rate, and there's shoes that could potentially drop that we just need to be aware of. So there's going to be a couple things we'll touch on next week. Some potential shoes that can drop in the housing market. And then also, what are some good markets that put my money given all the circumstances that I just talked about? So tune in next week. We'll talk about some safety and some other things going on under the hood. Thanks for joining us on Your Investment Advisor channel. Expertise you deserve, experience you can count on.